Welcome to The Explainer. So today we're going to go on a bit of a quest. We're going to pull back the curtain on one of the biggest secrets in investing. How in the world does Warren Buffett figure out what a company is truly worth?
I mean, it's the single most important question for any investor, right? You see that stock price blinking on the screen, but is that the real value or is it just noise? Getting to the truth behind that price, well, that's our goal today.
And Buffett himself gives us the map. He calls the treasure we're looking for intrinsic value. Think of it like this. If you own the whole company, this is the total pile of cash you could take out of it, from right now until the day it shuts down, all brought back to what that money's worth today.
So our first step on this quest is to cut through all the accounting fog and find the actual, real, spendable cash a business makes. And Buffett, he has a special name for this.
It's called owner's earnings. And this isn't just some profit number you see on a spreadsheet. No. This is the actual cash left in the till after you've paid all the bills and you've spent the money just to keep the business running exactly as it is.
And here is a really critical difference. A lot of people use something called free cash flow, but that subtracts all the big spending, what they call CapEx, including the money you're using for big growth projects. But Buffett's insight here is brilliant. He says that spending on growth is really an investment for the future. It's not a cost of doing business today. So his owner's earnings only subtracts the money needed for maintenance. That gives us a much truer picture of the cash you could actually stick in your pocket.
All right, so we figured out the cash the business is making today. But this next stage of our quest, well, it gets a little trickier. Because now we have to pull out a crystal ball and try to predict the future.
And Buffett is the very first person to admit this. He says, look, two people, even him and his famous partner Charlie Munger, they can look at the exact same set of facts and come up with different intrinsic values. So the really crucial point here is, this isn't a magic formula. It's about sound judgment. It's an art.
So to make our estimate, we basically have two key levers that we get to pull. First, there's the growth rate. How fast are those owners' earnings going to grow? And the key, as we'll see, is to be conservative. And second, there's the discount rate. Just think of this as the return you need to get each year to make this whole investment worth the risk and worth the wait.
So how do you actually pick a discount rate? Well, you could use the rate on a basically risk-free government bond as your starting point. Buffett does this a lot. Or you could use what the stock market has historically returned, which is around 10%. But you can also set your own personal hurdle rate. Say you demand a 15% return. What that does is it forces the investment to clear a much higher bar, which in turn forces you to find a much better price.
Okay, we have our owner's earnings. We've made our estimates for growth and for risk. Now it's time to bring it all together and actually calculate our company's intrinsic value.
I know it sounds complicated, but it's really just three logical steps. First, you project those owners' earnings out for the next 10 years. Simple enough. Second, you add what's called a terminal value. That's basically a lump sum guess for what the business will be worth from year 11 into forever. And finally, you use your discount rate to pull all of that future money back to what it's worth in today's dollars. That's the core of the whole calculation.
Now let's look at an example using the pharmaceutical company AbbVie. After running the numbers, using a pretty conservative growth estimate, the formula spits out a calculated intrinsic value of around $337 per share.
And here is the aha moment. We take our calculated value of $337 and we compare it to the actual market price at the time, just $110. That gap, right there between value and price, that is what a value investor lives for. But hang on. Before anyone gets too excited, we need a major reality check. Because our entire calculation, that whole $337 number, it hinges on those estimates we made. What if we're wrong? This is exactly why you have to run different scenarios. If you plug in a lower, worst-case growth rate, that intrinsic value might totally plummet, maybe even below the stock price. If you get too optimistic, it soars into the stratosphere. It just goes to show you how incredibly sensitive that final number is to your assumptions, which brings us right back to that key idea. This is an art, not a science. So, if the calculation is so fragile, if it's so wobbly, how can anybody invest with any confidence? Well, this brings us to the climax of our quest.
This is the single most important principle that protects investors from their own flawed estimates.
The secret was given to Buffett by his mentor, the great Benjamin Graham, who is really the father of value investing. And it's just 3 simple words: margin of safety.
And Buffett's analogy for this is just, it's perfect, it's unforgettable. He says you build a bridge to hold 30,000 pounds, but you only drive 10,000-pound trucks across it. That huge gap, that cushion between what the bridge can handle and what you actually ask it to do, that is your margin of safety.
As Buffett says, you don't try to buy something you think is worth $83 million for $80 million. The potential reward is tiny, and hey, your estimate could easily be wrong. No, you look for the chance to buy that $83 million business for $40 or $50 million. That gives you an enormous buffer against bad luck, bad timing, or just being plain wrong in your analysis.
And that's the ultimate takeaway here. The whole point of this valuation process, it's not to perfectly nail the future. That's impossible. The point is to understand the business well enough to make a conservative estimate and then, and this is the key, only buy at a price that gives you a massive margin of safety. That's what protects you when your estimates, inevitably, fall a little short.
So this leaves us with a final question to think about, and not just for stocks, but for pretty much any big decision. As you look at your own investments, your own big bets, ask yourself, which one has the biggest, strongest bridge?